Hey, what's up, guys? It's Jonathan here. Great to be live again. So, we got a lot to talk about, man. This market, what happened today was absolutely insane. Some of the news that we got was just crazy. Um, but anyways, let's just get right into it and let's just start off with talking about how the market did today. So earlier in the day, we got the PPI reading, which PPI stands for Producer Price Index. There has been, I believe, I have posted videos about the. Sorry, getting some feedback there. So PPI. So we have talked about PPI. It is a big driver. You know what? Let me set this up as a video so I could post this later. So let's do this. Hey, what's up, guys? It's Jonathan here. So, we got a lot to talk about, man. The market today was absolutely insane. So, let's just start off with some of the catalysts that happened today and get into the details. So, earlier to start off the day, we got the PPI reading for, well, we're in November, so for October. And the expectation that was that we're going to get a year over year reading of 8.3% and a month over month reading of 0.4%, and we actually got a year over year reading of 8% and a month over month reading of 0.2%. And core PPI was flat month over month at 6.7% year over year. So these were definitely way better numbers than we were expecting. And it kind of echoes what we saw with the CPI inflation, which kind of makes sense. Pretty much the way to think about it is that PPI is the price that producers are paying for raw materials. So, for example, like this shirt that I'm wearing, the person who paid for the cotton, um, or whatever material it's made out of, they paid a certain price for it. That shows up on PPI, and then me buying the shirt as a consumer shows up on CPI. So again, like I said, it does echo what we saw with the CPI data, which is we're starting to see it move to the downside. The cost of goods declined month over month, including food and excluding food and energy, which again, similar to CPI. We did have some increases in food and energy in the CPI, but we are seeing it with the PPI as well, which is reinsuring. We're also seeing the cost of services decline year over year for first time since the post-pandemic era. So that's another good sign that inflation is finally deflecting to the downside. So news of this caused the market to soar in the early trading hours, and we did see some pretty nice bump ups in a lot of stocks. I think Tesla was up like almost 5% for the day, which like this year has been basically a rarity. Most of the time, it's usually down 5%. But yeah, so this did add to that argument that we will see the Fed start to slow down the rate hikes, if not completely stop the rate hikes very soon. And that's some of the reason why we saw the market rally. But then later on in the day, we got some news that caused the market to fall, and that was the news of Russia potentially bombing Poland. So later in the trading day, a report came out where apparently a Russian-made rocket fell on a village that killed two people near the Ukraine Poland border, and um, Poland moved to Poland moved to enact Article 4 of NATO's charter, which pretty much states that attack on one NATO country is attack on all NATO countries. And this triggers an emergency NATO meeting that is scheduled for Wednesday to determine how NATO countries will move forward with this action that happened. Um, and obviously, this struck fear that we may be walking into a possible World War III scenario, which sent the market basically in free fall when this news came out. Russia did come out and they did say um, that they were not involved with that bombing at all. And the Polish president did state that there is really no evidence to believe that Russia was behind this attack. And really, honestly, I don't think Russia really has a good reason to attack Poland. I mean, they're kind of already in a dogfight with Ukraine. I highly doubt they want to spread this war any further. Um, but I don't know what's going on in Putin's head, so I'm not even going to speculate. But um, yeah, there's no evidence that it was Russia, but there is definitely going to be intense investigations to figure out what happened there. So this is definitely something we want to watch out for in the next couple of days in the market, as new developments may make the market more bearish or bullish depending on what's going on, and also depending on what you're invested in. Generally speaking, with war fears, the only thing that does well, um, sometimes sometimes the like industrial war complex, so like Lockheed Martin and companies like that make weapons for war. Though they usually do well if there is fear of war. Something else that could do well as well is gold. Like again, I always say, I'm not a financial advisor. I'm in the process of becoming a financial advisor, but I'm not a financial advisor. I'm not your financial advisor. So I this isn't financial advice, but those are generally some things that tend to do well in wartime fear. So I'd like to thank you guys for watching. I'll see you in the next video. Peace. All right. So there you go. That's the first topic we want to talk about. Let's see if we have any um, questions. Doesn't seem like we really do. Hey, what's up? Nora the Stock Explorer, thanks for joining us here. So let's move on to our next topic, which is going to be housing and the real estate market. So let me set this up. Hey, what's up, guys? It's Jonathan here. So we know that the real estate market has taken an absolute shellac in the past about 8 or 9 months, as the Federal Reserve has tried to increase rates and tighten done monetary tightening. And on this path to tightening financial conditions, I um, I'm sorry. They have been putting a lot of pressure on the real estate market, like I said, and this downwards pressure, um, and we could be seeing, and with the recent news that we've gotten in terms of inflation, we might be seeing the Fed start to relax. That could possibly turn the real estate market back to positive and stop putting so much negative pressure on the market. So let's talk about it. So we have seen a pretty significant collapse in real estate transactions. Obviously, when real estate rates go up, less people can afford to buy real estate. When less people can afford to buy real estate, usually start to see transactions start to slow down as there's less buyers, and then the sellers are not they can't get top dollar. Even if you were to sell, you would have to now buy again. And why would you sell a mortgage that's at like 2-3% so you could buy with a mortgage that has like 6-7%? Doesn't really make any sense. So we have seen transactions collapse 27% year over year, and that has caused a lot of pain in a lot of real estate related companies, especially companies that make money off of transactions. Those are typically real estate brokers, kind of like EXP Realty. And then also Redfin as well. They do have a brokerage arm of their business. So and also not only that, but also lenders like United Wholesale Mortgage and Rocket Mortgage have been taken quite a shellacking as well, as refinances are down again. Why would you want to refinance out of a 2.5% loan to get a 7% loan? Doesn't really make any sense. So, um, and like I kind of thought about this because so what happened with me is that I had a mortgage with United Wholesale Mortgage, and they just recently sold my mortgage off to a different bank. And I was kind of trying to think about why they would do that and kind of what their game plan is there. And my first thought was that they're trying to offload a lower interest rate loan so they could so then they could use that money to take on higher interest debt so they can make a bigger spread on the fees that they take. So the way a lot of mortgage servicers work is that they'll usually they collect your payment. Let's just say you're paying $200 in principal and then $100 in interest. They'll take that $100 and they'll take their fee out of it, and then they'll give the rest to the investor. So basically, if you have a mortgage loan that's a higher rate, then you're taking more interest payments, which means you could take a higher fee from it. But there was also, but I thought that was didn't really make too much sense. So another way I looked at it, and this was something that was confirmed to me by reading through some of I read through Rocket Mortgage earnings report, and it confirmed this thinking that I had, that these companies are selling loans to be able to reduce their cost. And the way that would work is that if I'm servicing a loan and I sell it to someone else to go service, then that now allows me to have less employees to have to support the servicing of this loan. So it's almost kind of like a cost cutting method, that is kind of like a cost cutting strategy that servicers can use. And we are starting to see a lot with these servicers that only do mortgages and that aren't like multi loan, or like banks, kind of like Chase or um, Bank of America. I so I between reading earnings reports and also some news articles as well, that kind of confirmed my thinking that it is a cost cutting method that a lot of these mortgage issuers are using, especially as they're feeling the pain of the real estate market collapsing. So when it comes to rates, we started off the year at like 2%, and I believe we peaked somewhere around 7.5%. But recently we have been turning to the downside. So we were at 7.5% just in the past about month or so. We have come down to under 7%, and currently right now rates are sitting at about 6.9%. And that and we can also tell that through the 10-year yield as well. The 10-year yield was at 1.5% back in January, and it peaked at 4.25%. And recently it has come down from that 4.25% peak all the way down to 3.8% that it currently sits at. And I think a lot of this is really, again, the rates are, for the most part, they're determined by the Federal Reserve and their actions on the Fed funds rate. That really is what moves bond markets. But there is some wiggle room in bond markets for speculation for future events that are going to happen. So I think why we're seeing rates start to turn to the downside is because the market is anticipating a Fed pivot or a Fed U-turn, where the Federal Reserve will stop hiking rates and at some point will consider even lowering rates. Now, I think that that's going to take a very long time before we start seeing the Federal Reserve slashing rates. But I think if we do start to continue to get good inflation readings, we will start to see the Fed taper off their rate hikes. So basically, let me give you the information that you can actually use. So, when should you start looking to buy real estate? Well, you know, it, I have to do the whole professional thing, and I'm not a real estate agent, so I can't give you real estate advice. Go talk to a real estate agent to get advice. But in my opinion, I think that the best time to start looking to buy is anywhere 3 to 6 months after the Fed reaches its terminal rate. And here's the reason why. So let's just say the so generally speaking, if the Federal Reserve hikes rates all the way until, let's just say, February, then the people who are buying in February are still got pre-approved like 3 months ago. So they got pre-approved back in October, and they're shopping in like late January, February. Well, right at that time, they're gonna set the market is gonna move based on the rates that they have, or based on the comps that they're using to buy, which is the rates from the previous month, which is the rates from which is the people who were previously buying. That's the comps that they're going to use to buy, that the people who are buying in February are going to use. So you have to give it about 3 months for all the rate hikes that have happened in the past to catch up to the buyer. Then as soon as it catches up to the buyer, it's still going to take another 3 months of turnover of the comps before those prices are reflected in the real estate market. So in total, it's probably going to take 6 months before you start to realize the full effect of what the Federal Reserve has done in terms of hiking interest rates. And right now, the market currently thinks that the Fed will stop hiking rates in their late January FOMC meeting. So, considering that 6 month time frame, and then you add on the additional about week to 3 weeks that it takes for interest rates to adjust according to what's going on in the bond market, then I think that's probably when you want to start looking to buy real estate. Now, I will say there are two exemptions to what everything I just said about the real estate market. First, well, I should say two assumptions. The first assumption is that inflation has already peaked in the last CPI reading, not the October one, but the one before that, which was September. That September reading was the peak, and then October onwards is now going to deflect to the downside. If we end up getting another high reading in December for November CPI, then like everything I just said, worthless, because the Federal Reserve will go back on being aggressive and hike, and spend less, spend less, spend less, and all that stuff. So that's really the big, I think, that's really the big assumption that we have. Then the other assumption is that the Federal Reserve doesn't start dumping mortgage-backed securities onto the market. Now, it's kind of been hard to get a gauge on when the Federal Reserve plans to do this, because they have been talking about dumping their mortgage-backed securities, but it seems like they have really made no progress on that. I just checked their balance sheet, and I compared their first balance sheet in January to now, and they basically have the same amount of mortgage-backed securities on their balance sheet. So who knows when they will start dumping mortgage-backed securities. I know they said they didn't really want to do it with the rate hikes as well, because it was just going to put too much downwards pressure on the real estate market. They may have even just been keeping it in their back pocket, just as kind of like a tool, just in case they can't get inflation down. Then they could start dumping mortgage-backed securities onto the market, which increases rates on mortgages, and then hopefully brings inflation down. So that's basically all I got for you guys. Thank you so much for watching. I'll see you in the next video. Peace. All right. So, oh, thank you for support, Nora. Um, be safe. Do not use your phone while driving. That's my adult thing to say for a day. There you go. All right. So, I wanted to share this with you guys. So, I was reading through, I think it was Bloomberg, um, and it was talking about, this is about FTX and cryptocurrency, and um, the founder of Galaxy Digital, Michael Novogratz, I believe that Novogratz, Novogratz. Um, he said something to the extent that he was talking about FTX, and he stated that it may take weeks before we hear of the war stories regarding the fall of FTX, and at least in terms of like the fallout from other firms that were financially linked to FTX, because like FTX went bankrupt and all of that. So, um, and he was referring to like the long drawn out pain in the stock market that resulted from the Lehman Brothers collapse. So it was pretty much he was trying to say that he believes that the pain in the crypto market will last much longer than most people think, and that will be a very long drawn out pain for the crypto market. And I was just thinking about this, and honestly, I kind of agree with what he's saying. That I don't think we've felt the full effects of the FTX fallout just yet. Even though it has caused the market cap of Bitcoin to shrink by 25% from before all of this news came out, I still think that we can still see a massive trend down in crypto. So really, um, especially that we um, we are seeing companies like Binance start to come in to try to support the crypto market. And like I've said in previous videos, I don't know how long a company like Binance will be able to support the market. You know, Binance isn't JPAL. They don't have a money printer. They can't just go out and consistently keep printing money and hoping to prop up the market. I am I am afraid that if Binance does go bankrupt, which they could absolutely not go bankrupt and everything will be fine, but if they do go bankrupt, some it could get really bad really quickly for the crypto market. And um I still believe there is some pain. I still believe that there is quite a bit of leverage in the crypto market. So whatever if we do get some massive downwards catalyst like that, it could really drag the market down. So personally for me right now, like I've said before, I'm not a big fan of buying crypto. It's very hard for me to consider buying crypto when Tesla is under $200 a share. Like it- I only have so much money, and I'd much rather just use my money to go buy the dip on like Tesla or Nvidia or all these other great companies that are suffering right now, rather than buying Bitcoin. But I think at some point when we do see maybe a relaxing of the Federal Reserve in terms of quantitative tightening, then I think I'm much bigger fan of um, buying crypto and speculating on it. But yeah, so that's my little crypto saying for the day. Seems like Nora has some Binance. You have BNB or you have crypto in Binance? That's interesting. Hmm. All right. Well, so let's move on and talk about debt. So when I said debt, I mean U.S. household debt, because we just got the New York Federal Reserve just released data on U.S. households and their debt. Actually, you know what? Let me restart this. Let me set it up right. Hold on, I need some water. Let me. Okay. Hey, what's up, guys? It's Jonathan here. U.S. the Fed. Gosh, that was not good. Hey, what's up, guys? It's Jonathan here. So the New York Fed just released data on U.S. households on U.S. household debt, and for the year over year, U.S. household debt is up 8.3% in the third quarter of 2022. Now you might be thinking 8.3%. That's literally inflation. So no, duh, it's going to be up. Inflation is up 8.1%. So no, duh, housing debt is going to be up. Household debt's going to be up 8.3%. But I will say, but let's get into it because it's a lot more complex than that. So this is the highest increase in house year over year in household debt since 2008. And this number, and like I said, this number isn't this number isn't adjusted for inflation. So basically, it's the same as inflation. But let's break it down. So obviously, the biggest debt that U.S. households have is mortgage debt, and that made up most of the year over year rise that we saw. It's up $282 billion in the third quarter, or about 9.3% year over year. Home prices in that same period rose about 7.5%, according to Redfin Data Center. So it is mostly in line. We probably did have some people who borrowed money to upgrade their homes, or to upgrade their homes by cash out refinancing, or just to get a bigger home in general, or maybe pulled money out of their home to go spend. So I'm guessing that's where we get that um, delta between the mortgage debt and home prices. When it comes to credit card debt, we did see that increase as well. It increased 15% year over year, which is the biggest increase we've seen in the past 20 years on a year over year basis. And with inflation at about 8%, it shows that balances aren't just increasing only because of inflation. And this data may make you think, oh, well, people are just overspending. They need to start saving money and start living within their means. But the report from the New York Fed did go on to state that there is a very massive discrepancy in how inflation affects different households. So credit card balances increased the most for borrowers between the ages of 30 and 59. And those who li- and borrowers who also borrows borrower, borrowers who also lived in low income areas with balances above pre-COVID levels, whereas balances of older borrowers and people who lived in higher income areas actually are still below pre-COVID levels. So people it is showing that people who are more affluent are having an easier time keeping their credit card balances down versus people who are in low income areas or who are younger. And it completely makes sense because inflation is a regressive. Gosh, what do you call it? Inflation is a regressive tax, which pretty much the definition of a regressive tax, because I know a lot of people use that word, but they never explain what it means. It's pretty much a tax that's applied uniformly. Like, think about it. If like, let's say somebody who makes $500,000 goes to a gas station and fills up their Honda Civic. Then someone who makes $20,000 a year goes to the same gas station and fills up their same Honda Civic. Well, then basically what happens is that, well, an increase of like 25% in gas prices affects the person who's making $500,000 much less than the person who's making $20,000. So even though the price increase is even for both people, it's not felt evenly with both people. And that is kind of what we're seeing with inflation. And it's kind of um gives the Fed almost this damned if you do, damned if you don't situation. Because if they raise rates, then that tightens monetary policy, which the ideal is that it's supposed to lower inflation, but it makes servicing debt harder for people, especially people with lower incomes. But then if the Federal Reserve doesn't raise rates, then we have a wage price spiral, which means more inflation, which makes it harder for people with lower incomes to live on a day-to-day basis. And this was this is why I got so irritated with the use of with the what Gavin Newsom did in California, because it's like, why are we giving inflation relief checks to people who make $500,000 a year? Like, that makes no sense. Like, it would have been one thing if it's like, oh yeah, we're gonna give inflation relief checks to everyone who makes under 60K a year. Great, because they're the ones who are suffering. It's not the people who have money who are suffering. Like, you know what? Cal, I'm not even gonna start with California. Let's not even do that. So another category that went up significantly in the New York Fed's report was HELOCs. So HELOCs were up 18% year over year, and people tend to tap into HELOCs, our home equity line of credits. They tend to tap into them to make very big unnecessary purchases. So like buying cars, buying boats, spending money, you name it. It's generally speaking, that's what most people tend to use that money for. And the Federal Reserve is has mentioned that they are looking into this to really see to get a feel how consumers are doing in terms of spending. And I think that they do want to see some housing wealth get crippled as well through their actions. So in that way, they slow down the consumer and they kind of squeeze out the buying power of the consumers. So it's definitely one to watch out for in future reports if we do want to see if the Fed will pivot or not, because they are looking at that as well. So overall, I'm not surprised to see debt on the rise, especially given that we have an inflationary recession where we have people who were stuck in the house, it's actually, you know what? It's actually funny because I was talking to my mom about this at the beginning of COVID, and we were talking about how once COVID is over, like once the lockdowns are over, people are going to go out and they're not only going to go out and spend like the money that they have, they're going to go out and overspend and they're going to spend themselves dry basically. And that's almost what we're kind of seeing happening, because it seems like people are just going to keep spending and spending and spending until they just don't have any more purchasing power, until they've maxed out the credit cards, they've cleaned out the bank account, they've cleaned out the home equity. It just doesn't seem like the spending will stop until everything is emptied. And the sad part about it is that we are moving into a more recessionary economy, and the saddest thing would be if someone who spend got themselves into all this debt, and then now they have to figure out how they're going, and then they lose their job at the end of it all. Then it's almost like, wow, they're screwed. And it's been something that I have been talking about for the past year, that the Federal Reserve might start tightening and they might start breaking things, and they don't care. They just want to tighten, get rid of inflation, and whoever gets massacred in the middle of all of it, that's their problem. Um it's very unfortunate, but it is the honest truth that of what happens during inflationary times, that really it's just get inflation down, get inflation down, get inflation down. So, um, I really think that we gotta watch closely on the consumer and possibly, hopefully, seeing them run out of money so we could finally start to see inflation come down. But you do have to realize this is a lagging indicator because we're getting data from that the accumulation period ended in, what was it, the end of September, and we're just getting it now in November. So it is a lagging indicator, but I think that this is like a really good data point for us to look at. So I'd like to thank you guys so much for watching. I'll see you in the next video. Peace. So yeah, it's absolute debt has absolutely skyrocketed this past, I want to say it started somewhere like in the spring, like around March, and it's just been going up and up and up. So it's crazy. Hopefully it stops soon, because the last thing you want to do is get into yourself into a bunch of debt right when we're facing a recession in front of our face. So um I don't use credit cards. Yeah, I mean, that's kind of I feel like that's kind of like the Dave Ramsey route. Like, just don't even touch them. You can't get yourself in trouble if you don't touch credit cards. And I mean, like, like for me personally, I use credit cards. I pay them off every month. I've never not paid them off every month. I will say that going the non-credit card route is not necessarily a bad way to go. There's always that argument of, oh, well, what happens if someone takes your debit card number and they use it to buy stuff? Well, you can always make fake debit card numbers. There's like, I know there's a legitimate website where you can like actually like type in your original credit card number, and then you could like get a fake credit card number and then use that to do online shopping. So it'll still charge your card. It just won't have direct access to your card. Um, but yeah, I mean, going the no credit card, no debt route, honestly, is probably less stressful. I mean, I I'm not gonna sit here and say Dave Ramsey is wrong or anything like that, but I will say that, yeah, that there is some truth to just not using credit cards at all. But I don't know. I'm I think I just have a little bit higher of a risk tolerance. But yeah, so you know, I want to go eat dinner. I'm hungry. I'm tired. It was a long day. So I'd like to thank you guys so much for watching, and I'll see you next video. Peace.